Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 30th of January 2024. Here's a weekly chart of WTI crude oil. Last week prices rallied sharply with WTI closing up nearly 6.5% following the escalation of the situation in the Middle East. Last week's breakout means that the path of least resistance is now to the upside, despite the weaker start to this week. Looking at crude oil prices in greater detail, this is the daily chart now. You can see that prices broke out of this consolidation pattern to the upside, and prices have moved above the 21-day exponential and momentarily at least the 200-day moving average as well, before pulling back down a little bit. The key level of resistance was this level that I had highlighted previously at 77.60ish. The price of oil has struggled to rise above that level ever since breaking below it back in November of last year. And once again, this week we've seen some struggles around this area. We also have the 200-day moving average, of course, providing additional resistance. So this is the key level to watch. If we get above this, again on a daily closing basis, I think this would be bullish. Let's see if that will happen today. And if so, the next upside target could well be the 80 level, which is a psychologically important level and comes in above the double top high that was created over here, meaning that there will be stops above those highs. And so naturally 80 could be a level where prices might be attracted to. On the downside, let's zoom in to see where the key levels of support lie. This shaded blue area is now the key support zone in my view for oil. This area had previously provided resistance before the breakout. Now it's being retested from above, and so far it's holding firm. Bullish crude oil traders will be happy to see that prices have refused to hold below the low of the previous day's candle when it created a bearish looking price action. The fact that it has bounced back despite breaking through this level earlier is a sign of strength if it can hold in terms of a daily closing basis. So a close above this level or well above it and potentially in the green today would be a strong bullish signal for days to come. The path of least resistance on crude oil will remain to the upside unless we see a bearish pattern unfold at the high levels, or we see price go back below 75, which is now the line in the sand for me. Speaking of commodity prices, it's worth keeping an eye on copper prices because it's now starting to trend higher again following its recent consolidation below the 200-day moving average, which then gave way, leading to a sharp continuation to the upside. So copper is going up. This could potentially be good news for the likes of Aussie and commodity heavy indices like the FTSE and Chinese equities potentially as well. Gold has broken its bearish trend line that has been in place since December when it peaked at a new record high. The fact that it has broken this bearish trend line is potentially a positive technical development, but it's happening ahead of the key FOMC meeting and US data coming up later in the week, which means that it's possible we could see a false breakout scenario here. Nevertheless, it's a bullish sign, at least from a purely technical point of view. Let's see if this breakout can hold. It is now testing resistance starting at around 2040, the shaded gray area, where the precious metal had previously struggled to hold. So a daily close above 2040, well above it, would potentially pave the way for a move up to the next area of resistance in this shaded orange area, where the previous year's highs converge. For example, we have the high of May of last year, the high of 2022, and that of 2020. So that area between 2075 to 2080-ish is the next level of resistance, or area of resistance, I should say. And beyond that, if we get there, there's nothing significant until that December record high at 2146-ish. On the downside, if we go back below this trend line, this would potentially be a significantly bearish development in my view, because it would point to a false breakout and a trap for the bulls, in which case we could see gold come back down to at least 2000, where previously gold had found support and resistance. But potentially it could go on to fall even further, perhaps to the 200-day moving average, which comes in at around 1965-ish, or even all the way down to the 61.8 Fibonacci retracement level. Now, the trigger could be if the Fed is hawkish or we see significantly strong US data, which could send bond yields sharply higher, which would reduce the appeal of low-yielding commodities, including gold, silver, and the Japanese yen. The Aussie hasn't been an interesting pair to trade really in the last few days because it has been consolidating around the 200-day moving average. But it has consistently found resistance from this shaded gray area, which was previously support, and where we have the 21-day exponential moving average coming into play. So that area needs to be reclaimed before we turn bullish on the Aussie dollar from a tactical point of view. Following this morning's stronger than expected GDP data from the Eurozone, the euro dollar bounced back from the around 108 key support area, which it tested yesterday and held. Now it is testing resistance at around 108.45, 108.50 area, where we have the 200-day moving average coming into play. This is a pivotal zone for the euro dollar. So a daily close above this level would be, at least from a technical point of view in the short term, would be a bullish development. Whereas if it continues to hold below it, then we could see a move back down to 108 and potentially even the December low at 107.25 in the coming days. Bullish traders would now need to see a confirmed signal to suggest that rates have bottomed, because it has spent several weeks declining, suggesting that the bearish momentum is gathering pace. So from a bullish point of view, what I would be looking for is a rally above 109 resistance, because if that were to happen, it would have created a higher high and a move back above the 21-day exponential. The dollar yen is consolidating in a continuation pattern. I think this, you can call this a bull flag pattern, a move above the resistance trend of this pattern at around 148 could potentially pave the way for a move up to 150 next, which is the next level of resistance. Following 150, the next target for the bulls would be the November 2023 high, which comes in at just below the 152 handle. On the downside, the key area of support is this shaded region where the dollar yen rallied away from earlier this month. So if we see a break below short-term support, let's say at around 147, if we go below that level, then we could see follow-up technical selling into this shaded region before we potentially see a bounce back. Ahead of the Bank of England's rate decision, the cable has broken the 21-day exponential moving average, but it hasn't moved much to the downside yet because we've seen strength in UK data of late, and also inflation data in the UK remains quite strong, suggesting that the Bank of England is going to remain on the hawkish side a little bit longer than it had been expected previously. So from here, if we go above 127.20, which is the 61.8 Fibonacci retrace against the July 2023 high, a move above that level will create a break above the short-term trend and thus create a bullish signal. So should that happen, 128 or even the December high at 128.30 or just below that could be the next upside targets. On the downside, key support comes in at around 126 area, where the cable has previously bounced on several occasions. The 200-day moving average is at 125.60-ish. Then we have the psychologically important 125 handle slightly below that. So those are the key levels to watch on the cable. For more analysis and trade ideas, make sure to check out the news and analysis section at cityindex.com.